Welcome to Money Mastery Hub, where smart financial decisions create lasting wealth. Let's master money together.
Okay, picture this for a second. You walk into your local bank, sit down across from a loan officer, and formally request a line of credit to finance a burrito for your lunch. I mean, it sounds absolutely ridiculous, right? A bank can't exactly repossess your half-eaten food, and they definitely can't confiscate the memories of that front-row concert you went to last weekend on borrowed money. But as crazy as that scenario sounds, millions of people are literally doing this exact same thing every single day without even realizing it. We are actively taking out loans for fleeting, everyday consumable stuff. And just to put the massive scale of this into perspective, nearly a third of all Americans have used a buy now, pay later service at some point. But here is the truly terrifying reality hiding right beneath all that convenience. Almost 1 in 4 Americans using these services has actually missed a payment in the last year. I mean, that is just a staggering rate of default for something as casual as clicking a little button at checkout. So, welcome to this explainer. Today, we're diving deep into the hidden costs of buy now, pay later. We're going to decode the intense psychological manipulation hiding right there behind your checkout screen and figure out why the supposedly free money might actually be a highly sophisticated trap.
All right, let's get into the behavioral economics of this, because it all starts with human behavior. To really understand why buy now, pay later, or BNPL, has absolutely exploded, we have to look at a foundational concept called the pain of paying. Basically, whenever you spend money, your brain experiences actual, literal psychological discomfort. It's a moment of mental friction. You're standing there, actively weighing the value of that shiny new thing against the literal cash leaving your pocket. Now, historically, handing over physical cash hurt the most, right? Because you physically saw it leaving your hands. Writing a check? That hurt a little less. Swiping a credit card distanced you even further from the pain. But what the BNPL industry has done is take this concept and completely weaponize it.
You know that feeling when you reach a traditional checkout page online? Companies know you're probably already experiencing decision fatigue from picking out the right color, the size, the style. So the absolute last thing they want you to see is a massive total price tag, say a really painful $1,000 total. That high psychological friction might make you panic and abandon your cart altogether. But buy now, pay later swoops in and shrinks that massive, scary number down to a highly digestible $250 today. Now, obviously, the product hasn't magically become cheaper, and your income definitely hasn't increased, but psychologically, the friction is just gone. Your brain actually feels like you just saved $750 today. And this brings us to a fascinating yet super dangerous reality about our brains. We are biologically hardwired to place a much higher value on immediate rewards than on any future consequences. Companies intentionally design these checkout experiences to deliberately exploit your dopamine reward cycles. You get this massive dopamine hit of securing the new purchase right now, in this very second, while the financial sacrifice, well, that's pushed off into the distant, foggy future. Honestly, it's a brilliant piece of marketing because it seamlessly transforms what really should be a calculated financial decision into a pure, impulsive, emotional reaction.
Now, you might be thinking, dividing a single purchase into a few small installments doesn't magically create financial ruin. And you'd be right. If you just used it once, you'd probably be perfectly fine. But money isn't spent one isolated decision at a time. The real danger is the combined weight of all your choices. Because each individual payment feels so tiny, we just start stacking them. In fact, at least a quarter of all BNPL users are actively juggling 3 or more of these installment plans simultaneously.
Let's actually map out what that juggling act looks like in your real daily life. Suddenly, you've got multiple overlapping payment schedules running at the exact same time. So boom, you get hit with a $25 charge for shoes on Tuesday. Then a $40 charge for some gadget hits on Friday. Next Monday, there's a $60 charge for furniture. Before you even realize what's happening, a massive chunk of your future paycheck is already completely spoken for before you've even clocked in to earn it. You aren't paying for things you need today anymore. You are trapped paying for decisions that felt totally insignificant weeks ago.
So this raises a massive question. Let's call it the illusion of free. If these pay-in-4 loans don't charge you a dime of interest, how on earth are these multi-billion-dollar platforms making any money? Well, this brings us to a mind-blowing realization about their actual business model. BNPL providers, think Klarna, Affirm, companies like that, they aren't traditional banks. They're basically middlemen. To fund your purchase, they have to borrow money from capital providers or the open market. So every single time they issue a loan to you, they actually have to pay an origination fee. Let that sink in. They are actively paying money out of their own pockets to give you a free loan. Because of this middleman structure, these companies have historically lost massive amounts of cash, sometimes taking a hit of around 24% on each purchase. Just to put a number on it, Klarna recently reported an astonishing $136 million in credit losses. Why? Simply because everyday consumers are actively struggling to make their repayments. The whole system relies on you paying it back, and when the friction of spending is totally removed, people inevitably overextend themselves.
Okay, so if they're bleeding money on free loans, how do they actually survive? It's basically a highly effective two-phase bait and switch. In phase one, they lure you in with that sweet, interest-free pay-in-4 model. This builds up a massive user base and completely disconnects you from that pain of paying we talked about earlier. But once you're nice and comfortable inside their ecosystem, phase two kicks in. They introduce options to extend your payments over a much longer period. And guess what? That option is absolutely not free. In fact, it can come with staggering interest rates as high as 36.99%, plus late fees. They seamlessly transition you from an interest-free browser into a high-interest borrower.
Which leads us to what is easily the most counterintuitive twist of this entire system. You'd probably assume, quite reasonably, that if you're successfully managing all these overlapping schedules and paying off these tiny loans on time, you're proving that you're financially responsible, right? So, logically, it should boost your credit score. Well, the reality is actually the exact opposite. The crucial point here is understanding the difference between how these two systems actually work. A traditional credit card is what's called a revolving line of credit. You open it once and it stays open, kind of like a running tab. As time passes, it naturally matures your credit age. Buy now, pay later is a completely different beast. Every single time you use it, the credit bureaus treat it as a brand new individual microloan. So when you finally finish paying off those shoes, that specific loan account is closed permanently. Now, why does this matter so much? Because 15% of your total credit score is dictated by your length of credit history. If you're constantly opening and closing dozens of microloans for random stuff like DoorDash or a winter coat, your average credit age will literally never mature. Your score is going to stagnate or even drop. And worse, if you miss just one payment, lenders hit you with a severe penalty by reporting it. So basically, you take on all the risk of debt with literally none of the credit-building rewards.
And look, it's critical to understand that this psychological hacking isn't just a localized issue. It's a massive global behavioral shift. For example, research out of India shows that a whopping 66% of surveyed young consumers have adopted BNPL, heavily using it for both essentials and just fun lifestyle purchases. And while sure, some manage it totally fine, a huge portion report feeling moderate financial stress, openly admitting that the service actively encourages them to overspend. The illusion of convenience and that sneaky debt trap that follows is entirely universal. So, what do we do about it? How do we fight back and actually protect our wealth? Well, here is your defensive game plan. First, implement the rule of 3. Before you ever click that Buy Now button, calculate the total price. If you do not have 3 times that amount sitting comfortably in your disposable income after your rent and bills are paid, you cannot afford it. Period. Just delay the gratification and buy it outright later. Second, you have to treat BNPL exactly like high-interest credit card debt. Never, ever use it for consumable items like food. And if you absolutely must use it for a larger necessity, set up automatic payments immediately so you never accidentally trigger that insane 36% penalty rate. Finally, just recognize the psychological triggers we talked about today. Take the blinders off and see the dopamine hit for what it is.
So the very next time you find yourself hovering over a checkout screen, I want you to stop and ask yourself, are you evaluating the true cost of this product, or are you just looking at the monthly payment? Because true financial freedom isn't about how easily you can buy something today. It is entirely about how much power you retain over your own money tomorrow. If this explainer opened your eyes to some of the invisible traps hiding in your daily spending, make sure to subscribe to the Master Money Hub community. And I would really love to hear from you guys. Have you ever found yourself juggling way too many of these payment plans at once? Drop your experiences in the comments and let's talk about how to break the cycle. Stay smart, stay fiercely independent, and I will see you in the next explainer.
Thank you for watching and spending your valuable time with Money Mastery Hub. Please like, share, subscribe, and turn on notifications.